Well, let's start off taking stock of the status of things as they stand right now, from your perspective, because last year's risk-off scenario seems to have dissipated somewhat, albeit on the back of very cautious optimism right now.
I think that's right. If you look at this year versus last year, the big difference is starting this year, everyone was extremely pessimistic. So our perspective was that actually news would surprise in the upside. As that has come through, and the big tail risks in terms of the European banks going bust, hard landing, or a double dip in the US have come out, that's allowed markets to go up. And so in terms of the actual real world or the real economy, I don't think there's been that much of a difference. So a lot of what's been coming through has been a change in multiple. Markets were too cheap, so they were able to re-rate on just the absence of bad news.
Okay. The absence of bad news, but to look at the status of things right now, there's a lot of political posturing, for example, that's going on over in the EU, and that's putting Europe as a whole on a very precarious stage right now. What's your assessment of that situation, and how is it influencing your investment decisions here in South Africa?
I think you're right to flag up politics. It's a relatively new thing for us, but politics are going to drive markets. And it's not just in Europe, it's in the US. Even in South Africa, the road to Mangwana.
And the Middle East.
The Middle East is clearly one of the big risks there. So I think politics is going to come into investments more and more. And in fact, that's one of our big long-term themes. And we call it big government. The bottom line is governments all around the world are largely bust. Well, bust is too strong a expression. They're over-leveraged. Yeah. And that means that politics is going to play more of a role. In terms of Europe, obviously, the big fear is Greece, and that ebbs and flows there. My view is markets have largely come to terms with Greece. If it exits, it's not going to be a train smash. And the reason it's not going to be a train smash is because the risk of Greece is not Greece itself.
Yeah.
It's the risk on the banking system. And with the long-term refinancing operation, that risk has been materially reduced. And we'll have a second tranche of that coming in later this month, which will reduce that risk again. So I think in terms of Europe is not going to fix itself in the next year, the next 2 years. This is going to be a problem for at least a decade. But the noise around Greece, I don't think it's enough to derail markets completely.
What markets are also doing is largely getting used to the kind of liquidity that's being pumped into the system to prop up the world economy in the interim. I mean, we've seen it over with the Bank of Japan this week. Expectations are that the ECB, is going to be supplying ample liquidity again later this month, and that's continued to underpin the markets. What are you making of the quality of that underpin? Because already we're starting to hear conversations as to whether further stimulus should be a conversation being had in the US, or whether we should be pulling away from easing policies and focusing more so on recovery policies.
I think if you take that first theme as your starting point, which is big government, the only way you get out of being bust is by either defaulting or negative real interest rates. So because of that problem, we've got the second theme, which is cash is trash. So very low interest rates for a very long time. And whether that's deliberate money printing, you mentioned Japan, that's an extra 10 trillion yen, 130 odd billion US dollars. It's quite a big addition to things. So the negative of big government is we have low growth, it's unexciting, and it means negative or very low returns from cash and bonds going forward, which is bad for savers. So I was at a retail function today. One of the key messages is for people drawing on living annuities. They've got to draw less because they're not going to get as much return. So they've got to cut their cloth accordingly. And if you're young and you're not actually retired, you've got to save more.
Yeah.
So, but from that stems this cheap money or easy liquidity. And I think it does create an underpin for markets. And markets would not be where they were without that. And the risks would be much higher. But that liquidity is continuing to be put out there and is basically supportive of equities.
So let's bring it back to how this is, this entire dynamic is influencing your investment strategy on the local market scene right now.
Okay, so the bottom line is last year equity earnings were good, markets fell, therefore they got cheaper. So broadly equities are fair value against all the other asset classes, they're cheap. there's lots of liquidity, there's a lot of pessimism. I would recommend being overweight in equity. That's how our funds are positioned, but I don't think we're looking into a great time ahead. So this is much more of a muddle through. So that overweight, there's risk to it. So you need to have protection, you need to be well diversified, and it's certainly not a bull market outlook ahead of us. So I think for a balanced fund where you've got a maximum of 75%, I think that would be way too aggressive. We'd have less than that.
So some of that protection coming through via diversification. What about a defensive nature of your portfolio? Because we've been having conversations about now possibly being the time to switch out of a defensive characteristic more so into your cyclical stocks that are showing more value.
Well, if you look last year, the bubble was actually a flow into defensives. So defensives became expensive, and cyclicals are generally quite cheap. I think you want to actually have a mix of the best of those. I would look more from protection through, you've got the potential to put derivative strategies which would protect against the downside while not giving up too much of the upside.
What about offshore exposure?
Okay, so in terms of offshore, cash and bonds are, in my opinion, uninvestable because you've got negative real returns coming through there. What you do, and unlike last year where the rand had been exceptionally strong coming up to it, the rand last year was the weakest currency out of the major currencies. So I don't think you're going to get that additional boost from currency depreciation. Therefore, your reason to take money offshore is for diversification. That makes complete sense in this environment. There are opportunities.
Some value incentive as well, where those stocks have been severely hammered. You know, we've been having this conversation about just how selective you've got to be when you're vying into global stocks, because most of them have their, or quite a few of them, have their exposure in emerging market territories anyway.
Look, I think in terms of the relative value, South Africa's days of being exceptionally cheap relative to the world are over. And that's actually true even for emerging markets. So 10 years ago, emerging markets were very cheap relative to developed. That gap has narrowed. Now, you would need to be more selective. Personally, if I look at last year, emerging markets underperformed quite sharply, not just through their equities, but also the currency was weaker and risk spreads in terms of bonds were sold off. So, and that was, emerging markets were hiking rates. This year they're cutting rates. So I think the liquidity environment for emerging markets is actually a little bit better. So like on like, I think the outlook for emerging markets is stronger this year than last year, and would recommend an overweight position.